You want to build wealth, but you don't want to spend hours managing investments. You don't need investing to be a daily obsession to grow long term wealth. You need a simple system that will run quietly in the background. And that's exactly what passive investing is built for. Now, before we get into specific portfolios, I want to cover a few guidelines that I think about before I make every investment decision. Fees can quietly eat away your returns over time. Even a 1% annual fee can cost you huge in your final portfolio over a few decades. I try to stick to low cost index funds and ETFs where possible. If two funds track the same thing, I usually go with the cheaper one and move on. Your risk should match your age and lifestyle. Younger investors can usually afford to be more aggressive, while those close to retirement need more stability. The goal is to take enough risk to grow your money without exposing yourself to losses you can't recover from. Diversification means spreading out your investments among the entire market and not focusing on a single area. I want broad exposure so that one area doesn't make or break my portfolio. Put your growth investments in tax advantage accounts so they can grow freely for years. Put your income producing assets in accounts where taxes are delayed. Automation removes emotion. I invest the same amount on a set schedule no matter what the market's doing. That way, I'm in the market consistently and there's no pressure to try and time the market perfectly. With these ideas in mind, let's look at some specific strategies you can implement in your own portfolio. A target date fund is a one fund portfolio that automatically adjusts your risk as you get closer to retirement. It's built for people who want the simplest system possible. You pick a fund closest to your expected retirement age, invest consistently, and the fund handles the rebalancing and diversification for you. The big advantage is convenience and behavioral protection. You don't have to manage a bunch of funds, and you don't have to make frequent decisions. The benefits here include simplicity, automatic diversification, and no maintenance. And some of the trade offs include slightly higher fees and no customization. This works best for someone who wants a hands off approach and values simplicity over fine tuning. This portfolio is 90% in an S&P 500 fund and 10% in short-term bonds. That's it. It's famous because Warren Buffett recommends it for investors who want broad market exposure without the complexity. The S&P 500 drives the long-term growth, while the bonds act as a cushion during downturns. The beauty of this strategy is how simple it is to understand and how easy it is to stick with for decades. The main benefits are simple, low cost, and easy to manage. Some of the trade offs: no international exposure, and it can feel volatile during market swings. This approach is for investors who are focused on long term growth, who want a clean, straightforward system without overthinking. The three fund portfolio spreads your money across a total US stock market index fund, a total international index fund, and a total bond index fund. The idea is to own the global market instead of relying on a single country. You adjust your stock and bond mix based on your risk tolerance, and you rebalance about once a year. The main benefits here are broad global diversification and flexible risk control. Now, some of the trade offs are it requires an occasional rebalancing, and it's a bit more involved than the previous portfolios. This is a strong middle ground for investors who want diversification with manageable complexity. Paul Merriman's four fund portfolio. This strategy splits your investments evenly across four index funds: S&P 500, large cap value, small cap, and small cap value. It focuses on smaller and value focused companies, which historically have delivered higher long term returns. Each fund stays at 25%, and you have to rebalance on a regular basis. The main benefits here are deep diversification and higher expected long term returns. Now, some of the trade offs are it may underperform the broad market for long stretches of time, and it requires strict discipline. This approach rewards patience. You have to trust the system and stick with it, even during slow periods. None of these portfolios need constant monitoring and can all grow long term wealth. Now, the difference comes down to how much control do you want versus how much convenience do you want. The best strategy isn't the fanciest one, it's the one you can stick with for 30 years. Pick a system, automate it, and let compounding do the heavy lifting. Thanks for tuning into this episode. I hope to see you in the next one.